S&P 500 hitting a record high earlier today before turning lower. Meantime, the Russell 2000 still well off its own November peak. Here to share her own outlook for the small cap space is BofA Global Research Head of U.S. Small and Mid Cap Strategy, Jill Carey Hall. It's good to see you again.
Thanks for having me.
All right. A lot of people think this might be your moment, but I don't know. You tell me.
Well, I think this is going to be a year where you want to own mid caps over small. I think it's still a tough backdrop for the Russell 2000, and the profits growth recovery story that a lot of investors were bullish on last year, that's just continued to get revised down, pushed out further into 2025. So small cap profits have continued to disappoint. And, you've still seen negative year-over-year earnings growth in that size segment. The fundamentals have been better in mid caps. So if we do see a market that broadens out, we think mid caps are actually the size segment that could offer the best risk reward, especially if you're now in an environment where multiple rate cuts have gotten priced out of the market. Our economists at BofA are expecting the Fed stays on hold from here and doesn't cut any further. So small caps obviously have a lot of refinancing risk, and that risk has sort of reemerged as the rate risks have gone up. So mid caps have better balance sheets, better fundamental trends. So that's where we would position, within small and mid.
So rates still matter more than anything else. Because I was going to say, with all the optimism around the economy going forward and policies from Trump 2.0, if not now, when? We've been waiting and waiting and waiting for some sort of sustainability from this space. Sure, we've seen great moves, but they've been short-lived.
Right. I mean, I think, after we've seen this decade of underperformance for small caps, historically speaking, we're due for an outperformance cycle. And that's what relative valuations would suggest. So I do think if you have a longer time horizon, over the next decade, which is when valuations tend to be the most predictive, that small caps could offer the best price returns of the size segments over the next decade. But, this year, I think there's sort of, after all the underperformance, it's a high bar for investors. They're sort of nervous about jumping back into small caps. I think there's definitely optimism there, optimism around the economy, optimism if we see deregulation. But the profit story, I think we'd like to see a more convincing turn. And rates stabilizing, or perhaps if cuts get put back on the table, those would be beneficial for small caps. The Fed and expectations have been one of the biggest drivers of the rallies and the sell-offs that we've seen in the Russell over the past year. December was the worst relative month for small caps versus large that we had seen in over 25 years. And a lot of that was right after the more hawkish Fed meeting. So I do think there's a lot of opportunities still within domestic mid caps. And so I really think this is a year where you want to be selective, and it's going to pay to be selective rather than just owning a benchmark. If you can own smaller mid caps that have profits, less leverage, less refinancing risk, or economically sensitive, I think those are well positioned. I think pockets of the market are certainly going to benefit from the backdrop that we're seeing if there is deregulation, if there is an M&A pickup. So financials look well positioned in our work, and just simply owning stocks that are seeing estimates go up rather than down has been one of the best factors within small and mid caps recently.